Hey, what's up? It is currently day 29 of trying to become a great investor, and today I'm gonna take it a bit easier. I just finished an interview this morning and kind of been relaxing and relaxing and try to not think about too much things. But I do have to go to the airport tomorrow for a trip over to California. My sister is currently sick though, so it'll be interesting to see how that plays out because I'm gonna be staying with her for a few days. But in the meantime, I was just reading through some articles on WSO, which I thought was interesting. And I'm just gonna read some random stuff. Let's see where it goes. Yeah. What are all these LTV yieldings? Only able to play in the unsecured in this example, where your shop is CLO because of the dynamics described in number 1. Irregularities come out of capital structure. Wait, am I? Oh, okay, nice. Capital structure analysis question. I have no idea what he's saying, so yeah. VC. Think asset management. Oh my god. Interesting take on the CA. All these are comp stuff. What? Delete the phone. Interesting. Watching Cox. It's cool. Okay, it's cool. Oh my god. Yeah, that's pretty funny. Using a sector to cover. Interesting. Reflections on Berkshire. Okay, yeah, interesting articles. More fun than I guess really learning anything. But I think right now probably just spend some time reading through some Anki flashcards and yeah, just read through some Anki flashcards. But I need to sync my thing on my actual phone. Let's see. Seven cards for 5 minutes today. Alright, let's just go with view then. What are the factors that affect the cost of capital for real estate owners? So the factors that affect the cost of capital for real estate owners are going to be the value of, or I guess the appreciation of price for the house. That's one. Second is going to be the depreciation of the assets within the house, maybe, or depreciation of the property itself. And then the third is going to be your reinvestment back into the property. Oh, this is the cost of capital, not for the growth. So the cost of debt, the cost of equity, equivalent scaling treasury per spread, risk premium. How can we think of the net present value mathematically? I think the net present value is just the difference between the present value of an investment and the cost of that investment. And so when we think about it mathematically, the net present value is just cost. It'll be present value minus cost. And the way we can think about the present value is, let's say we have a vector of discount factors and we have a vector of cash flows. It'll just be a dot product between the vector of discount factors and the vector of cash flows. So discount factor is simply just the present value of $1 to be received in however many of time periods or compounding periods or years. Maybe including the initial cost. What is the expectations hypothesis? I think the expectations hypothesis has to do with the field of interest rates and term structures. And so what the idea behind the expectations hypothesis is the fact that when you're looking at a term structure, the implied future rates are going to be the actual future spot rates within the term structure itself. And so what that means is that starting from today, if you make, let's say, an investment in a treasury security that matures in 5 years, then the return of that 5-year treasury is going to be exactly equal to the return of a 2-year treasury that's rolled over into a 3-year treasury. And so that implied future rate is the return of the 3-year treasury that you would receive in order to make sure that the returns on rolling over is going to be the exact same as the returns of just holding your investment. And so the expectations hypothesis believes that the actual implied future rate is going to be the actual interest rate you receive. What are some potential uses for term structure models? Some potential uses for term structure models are going to be, one, being able to model or calculate or determine what interest rates are going to be, and you can use that to determine yields. So yields into maturity, and then also maybe figure out prices. Estimate or prediction for what the security is worth at date T0. Determine whether a market maker is offering a receiving price. Mark to market assets. Yeah, I'm not too sure what. Determine what a market maker is offering, whether. Okay. So maybe does that mean that when you're looking at a market maker and whether or not they're offering a reasonable price? Mark to market assets. So determine whether a market maker is offering a reasonable price. So I guess you could use term structure models to kind of quote different types of securities. And so when a market maker is buying and selling and maybe offloading some of the securities or buying some of the securities, you can quote the term structure to make sure that the prices that they're offering is aligning with whatever the current term structure is modeling. So I guess that's something similar. And then the second is for mark-to-market assets. When you have assets that are currently on your books, let's say different types of loans, maybe that aren't publicly traded or just aren't as liquid as, let's say, treasury bills, which I think are traded every single day, and maybe using a term structure with some type of credit spread or default spread, you're able to use that to kind of mark to market, which is, I think, just a fancy way of saying being able to price your actual asset itself. So yeah, that's pretty tough. I'm gonna say hard for now. Net present value. Net present value is just the present value in excess of the initial cost of an investment. Okay. As initial costs getting those cash flows. What is quantitative easing? Okay, so quantitative easing is a type of strategy that is used by the central bank in order to kind of inject more money into the economy and artificially lower long-term rates, I think. So how central banks do that is they go into the markets and they end up buying a lot of long-term maturity securities. And so with that, that'll push the prices of a lot of these longer term securities upwards, because what it's doing is reducing the supply of the actual long-term securities, and it's also increasing the demand. So with this supply-demand imbalance, prices will rise usually, and that causes yields to fall. And I think maybe yields and interest rates have something similar or have something related to each other. So I'd say it's the best I got right now. Let's see. Central banks, the Fed, goes into the market and purchases a lot of bonds. A lot of bonds with relatively long maturities. This drives the prices of bonds up, especially long-term bonds, and the returns of bonds down. The effect is to enjoy. Yeah, I guess it's lower long-term rates. How does it do that? Good question. I don't know. What are the factors used to determine the growth rate G of real estate value? Okay, so this was in BUFN 400. And the factors that are used to determine the growth rates, this is I got this mixed up with another question earlier. It's the depreciation on the house or the real estate, the property, the reinvestment back into the property, and then also your house or property price appreciation. Investment house price appreciation. Okay. Preferred habitat theory. I think preferred habitat theory is just a way of looking at investments in different types of assets and making sure those assets, their cash flows align with some type of schedule or fixed, let's say every month, or every 2 months, every 3 months. Payment periods. Investors might prefer investments with specific maturities or payment periods. For example, life insurance companies funding annuities would want to have coupons and principal match up with the expected payouts. Okay, that's fair. What is the instantaneous forward rate? The instantaneous forward rate, I think, is the forward rates, which I think might be a future rates. Yeah. What is a forward rate? Forward rate is an interest rate. Is forward rate the same as applied future rates? Applied. Okay, I guess future rate is the same thing. Okay. The instantaneous forward rate, I think, is just going to be the forward rates or the future rates that we receive for an investment that matures instantaneously, so super quickly, maybe in a day or so. Let's see. Rate of return for an infinitesimal amount of time in practice, this time period might be 1 day or even shorter. Okay. What are the unique properties of the covariance matrix? So I think it's positive semi-definite. Forgot what that means. It's square and it's also symmetric. So symmetric, its transpose is equal to itself. Positive semi-definite. Current transformation invertible. Yeah, not too sure. This isn't really helping. I'm going to add red card here. Square. Say it's good. How can a term structure model value fixed income securities at multiple payoffs at different points in time? So a term structure model can value fixed income securities at multiple payoffs at different points in times because I like to think of a term structure model as kind of the yield curve. So it's a function of the time today and also the maturity of whatever security, maybe an asset in the future. And so with that, it'll spit out an interest rate. And so when you're looking at fixed income securities at different points in time, then you can use the term structure to evaluate what the rate of return would be for holding a maturity until, let's say, 5 years or so. What implied interest rates are pi k. Short rate, long rates. Long rate alpha. Oh, okay. So I think, but this is describing how one of the ways that Pete ended up making the term structure model, because he had some code in Python, and there was a function that he created that took in 3 parameters: the short rate, so the short-term interest rate, the long rate, long-term interest rate, and then alpha, which is, I think, how long the short rates would take to get to the long rate. So that another way of saying this is the slope of the yield curve. So that's interesting. Yeah. What is the first order condition for a quadratic optimization problem using matrix vector notation? Ooh, yeah. So this one I remember was y. Yeah, I'm gonna have to review some of this stuff because it's not really. These flashcards are kind of ass. The ones that I made, because this is super confusing. The quadratic optimization problem, what we're doing is, I would think we're taking, let's say, a vector of observations or estimations, we're subtracting it by the vector of real values, and we're squaring that to get the actual difference or the actual error. But I think the answer I have here is like y minus mx plus b transpose times b. So y minus xb transpose. First order condition optimized should be resemble the first vector weights b. Y minus xb transpose x. Oh, y minus xb. With respect to the vector of weights b. So I think this is our estimation. So y minus our estimation. And we multiply it by, what is this? Our actual observation. X, and that's equal to 0. Okay, so I think let's do some math here. I think the first order condition is going to be, not even the first order condition, just our optimization. It's going to look something like this. So this is our quadratic optimization. Is equal to y minus xb. Oh shit. Say we oh shoot. Study now. Okay, nice. Let's see. The first derivative with respect to x, text b. So then we have chain rule. So use chain rule. We have, let's do derivative with respect to of b squared. So this is going to be equal to 2 times 2 so we have in here we can use the chain rule to, so how does the chain rule work again? What the chain rule does, I think, it's when you have the when you're trying to take the derivative of a function that depends on the output of a different function. And so in this case, we want to take the derivative of y minus xb squared. And so we can think of this as a function that depends on the output of y minus xb. And so we might want to take the derivative of y minus xb with respect to b. And so that's just going to be negative x. And then we multiply that by 2 times y minus xb. So yeah, curious, so why is there no negative here then? X. So square wy minus xb squared is equal to x. I'm lost. Because I would think it would look something like y minus 2 times 2 y minus x vec b, and then we transpose negative x. How do we get to here? Okay, I am going to flag this. This is hard. Okay, the cost of capital for real estate owners. Some of the factors that are going to affect that are going to be 1, the cost of debt. So I think that's going to be some type of treasury security, and then you add some spread, the cost of equity, and then maybe something else I'm missing here, the risk premium with opportunity cost. Okay, I'll take it. Mathematically, it's just the dot product between a vector of cash flows and a vector of discount factors. Okay, so yeah, I don't really want to go through the red flag cards. So maybe we could take a look at machine learning. Hyperplane. Oh man, hyperplane. So that was talked about within the perceptual learning algorithm, which I think is one of the linear classifications we learned about. Linear classification models that really works well with binary classification. And so the hyperplane was the decision boundary that would kind of split our data sets, or our, I guess you could call it sample space, data sets, into 2 different halves, and whatever was above to the left, whatever was on one half of our hyperplane was classified as another half, as some type of class, and on the other half it's going to be a different class. And so the hyperplane is really just the decision boundary. Okay, it's okay. What is maximum likelihood estimation? Ooh, this one is a tough one. And I marked it, seems like I marked it red for a reason. So maximum likelihood estimation is something that I still haven't fully understood after taking this class. I think it has to do with the way you try to estimate parameters for your distributions. So I think one example is with a binomial, even easier, a Bernoulli distribution. There's a single parameter that you really need to build your distribution, and that's the probability of, let's say, a positive event. So once you have that probability, then you can find the probability of a negative event. It's just 1 minus the probability of a positive event. And so with maximum likelihood estimation, what you're trying to do is you're trying to find the parameter that would best fit some of your training data or your data sets. And so what I mean by best fit is that it has the lowest amount of error, I guess measured by some type of loss function. So distribution, okay. Maximize the number of data points for our sample that fits our distribution. Okay, it's hard. Conditional entropy. So y given x. Okay, so before I even get started on conditional entropy, I think I need to remind myself on what entropy actually means. And so I remember a good video by StackQuest. He described entropy as a derivation of what surprise is. And so surprise is kind of like the inverse of probability. Things with high probability have high surprise. Things with low probability have high surprise. So let me start that again. Things with low probability have high surprise. Things with high probability have low surprise. And so how that affects entropy is entropy is the probability weighted average surprise. That's kind of the mathematical definition of what entropy is. A more intuitive approach is just a measure of uncertainty. And so if you have high uncertainty, that means that your entropy is going to be high. If there's low uncertainty, then that means then I think that means your entropy is going to be low. I'm trying to think now, like, what is the math behind high entropy? Because if it's the probability weighted average surprise, then I'd say the highest amount of uncertainty is when everything is uniform. So you have all of your possible, what do you call these, events? All of your possible events have the same amount of probability. And so why is that mathematically your highest? Why does that mathematically give you the highest entropy though? Because the weights will be equal, the surprise would be equal. Probability weighted average surprise. Okay, so it'll just be the same, so it'll be x times log of 1 over x. I think log of 1 over x is yeah, it's a tough problem. I don't know if I can think about it in my head, because I'm trying to just imagine. I remember the way we calculate entropy is we take our probability times log of 1 over the probability of an event. And then we sum all of those combinations together to get the total entropy. But I wonder why if probability is the same across all the events, that means the surprise is going to be the exact same for all of the events. Okay, maybe more intuitively. So when you have the weighted average, all of your weights sum up to 1. And in this case, this means that for an event that has it's for a random variable that's uniformly distributed, that means the entropy is going to be log base 2 of is log just log base 2 of 1 over probability? That doesn't sound right. One half log base 2 of 1 over k. So however many events you have. One over 4, 1 over 5, 1 over 6, right? So log base 2 of 1 over 2, that'll be the conditional entropy. That wouldn't be the conditional, that would be the normal entropy for random variable x with 2 events. So 1/2 is going to be in decimal, and then so log is, what is it going to give you? Depending on the base, so log base 2, we're starting from 2, and wait, let's see, log of 2, calculator. Log of 0.5, -1. Wait, log of 1, 0. Log of 1/2 is equal to log of 1 minus log of 2. So 2 raised to the negative 1 is going to equal whatever. Okay. Yeah, I think getting kind of get carried away here, but the conditional entropy I think is going to be the h of y given x. In the case, I think this is a good case of this kind of relates to decision trees. So when we're looking at a decision tree, we're making splits on different types of metrics or characteristics, features of a specific sample. And the conditional entropy, I think, can be maybe the entropy after making some type of split or given some type of information. So, when we think about this, h of y given x, the entropy of some random variable y given some random variable x, given y is equal to some event, given x is equal to some event. Yeah, maybe look at what, if event x occurs, then what's the entropy of y given that event x occurs? That is the average uncertainty of y given the random variable x. This random variable x has multiple events that can happen, and so we can break this down further into h of y given x. Oh man. It's a lot of maths. My head is hurting. I need some food. Okay. The random variable x has multiple events that can happen, so we can break this relationship down further into h of y given x is equal to the probability of x is equal to some event times the entropy of y given x is equal to some event, which is equal to so it's a weighted average where the weight is equal to x, which is equal to negative given log base 2 of given x. Which is saying the conditional entropy of y given x is the probability of event x weighted average. Is the probability weighted average entropy of y given x is the event. Given x is the event. Given x is the event xk. The entropy of y given x is the event xk. It's defined as hy given x is equal to k. This is the same exact idea of entropy, but the probability space is limited to xk now. All right. So we're looking at all of the possible. I'm trying to picture what this would look like in my mind. So we have two random variables. I think y could be our label, and then x is going to be some type of a feature And so when we think about entropy, so the conditional entropy, when we're thinking about classification on a certain type of data set, and then we have a label y, a random variable of labels, then we could see if we limit the probability space or a sample space to just all of the samples that have this specific value for some type of feature, then this is the weighted average of that. So we're classifying, let's say, dogs, cats, or horses, and x is going to be, let's say, the weight. Maybe whiskers has whiskers or not. I think dogs and cats have whiskers. I don't know if horses do. And so maybe that'll decrease the entropy of y, which is our label, because we're kind of limiting now the possible labels for y. We're eliminating the horse label because usually they don't have whiskers. And so if x is equal to yes, then the entropy will be less. If x is equal to no, entropy will be high. It will be less as well. Okay. So I'm gonna say this is pretty hard. 0-1 loss. 0-1 loss is a loss function. And what it says is if you get it wrong, there's 1 loss. If you get it right, there's 0 loss. And so it's just counting the number of times you get something wrong, or your classifier gets something wrong. Zero, the loss is 1, not 0. It's 1, not 0. So it's pretty good. What is margin in the perceptron? So remember, margin is kind of the distance between your hyperplane and then the closest points within your sample space or your data set. I still don't really fully understand what the intuition behind margin is, though, because I keep hearing the fact that, okay, having a high margin is good because that gives your perceptron algorithm more room to kind of shift without overfitting the data. I think a good way of thinking about margin that kind of makes some intuitive sense is that higher margin means less prone to overfitting. So because you have more room to work with. Is that it? Is that all there is to it? Is negative infinity? Don't know. Are events independent and identically distributed when looking at conditional probability? Okay, so yeah, that's a good question about the theoretical. I feel like I'm just bullshitting here. But events don't have to be independent and identically distributed because with conditional probability, you're not really making that assumption. You're just saying, okay, what's the probability of this happening given that this had already happened? And usually events are independent if the probability of an event happening given another event happening is just the product of those two events. So probability of A given B is equal to the probability of A times B if two events are independent. That's not the same as probability of A given B is equal to the probability of A times B. That's not always going to be the case, though. Okay, pretty much similar to something what I said. Oh, yeah, okay, so this is a neuron. Describe what all the symbols mean and what the process represents. Okay, so I think some background here. I think this is just a neuron that's used within a neural network. And pretty much how it works, it's just some type of combination of inputs, some activation function that will transform the inputs, and then an output, which is just the transformed input. And so for every neuron, let's start kind of in chronological order here. Your input is usually going to be some type of linear combination of, I think, weights, values, and then bias. There's going to be a dot product between, let's say, the weights and then your values, and then you add some type of bias. And the weights and the bias are both hyperparameters that you can tune for a neural network. What I mean by a hyperparameter is just something that you can set yourself or you can train on to either improve or, what's the opposite of improve? Make worse the accuracy of your neural network. And so in this case, we have, I think, maybe a vector of inputs. So that's going to be our weight times our, so this is our weight vector, and this is going to be a matrix. Or I guess this is going to be another vector itself. And so we multiply the different components together. And then now we have this single value here. And then what we can do now is input that value into an activation function. So what this activation function does, it introduces nonlinearity into our model, into our machine learning model. So another flashcard we had earlier was the perceptron. And the perceptron was a linear model because all we're doing is we're taking a straight line, we're moving it, and then we're just making different types of movements for a straight line to best split our data set in half. So for data sets that are not linearly separable, meaning you can't just put a straight line through the middle to split all of the different classes in half, this is where neural networks come in. You're trying to fit, let's say, a squiggly line to a nonlinear data set. Some common activation functions are going to be your rectified linear unit. I think that's ReLU. Sigmoid, so that's an S-shaped function. And then, what's the last one? I'm blanking. Softmax. Or Soft Plus. Soft Plus, I think. So ReLU is like a straight line and then a angle up. ReLU is straight line, but it curves up. Sigmoid is just an S-shaped function. And then once you input your value into this activation function, it's going to spit out another value. And that's what we have right here. And then usually these values are then placed back into a vector itself, and then that vector is then used to be input into another layer of a neural network. These are the feature values of a single example. Double check. These are the weights of the inputs to the neural unit. Each feature value gets scaled by its corresponding weights, Wi, and we have the sum of xi, wi is equal to the inner product, the dot product of the feature vector x and the weight vector w. This is the linear activation of the inputs. We have our activation function that takes in the linear activation of the input. Linear activation of input, output of activation function. Okay, yeah, I'd say it's pretty good. What we have so far, the inner product, dot product, the linear activation. Okay, how do you find the probability of x given y in a naive Bayes classification model, where x is equal to a feature vector and y is equal to a label? Okay, so I'm just trying to refresh myself. A naive Bayes classification model, uses the, I guess, rules of conditional probability to try to make a prediction. And so usually we're given some type of data set, and within that data set we'll have labels. So it's going to be a supervised learning model, because what we're doing is we're having labels and we're training. But in this case, the naive Bayes classification model doesn't have a real training set, this training stage. All we're doing is we're computing probabilities here. And so what we classify something as, let's say, the probability of y given a feature value x, I think. Sorry, probability of y given a feature vector x. So that's our model. What's the probability of, we're trying to find the max probability, let me backtrack here. The naive Bayes classification model finds the max of the probability of y given x, where y is all of the possible labels within our data set, and x is a feature vector that we want to input into our model. And so what this means is that we're finding the highest probability of a feature vector, highest probability of a feature vector being a specific label. Okay, that kind of gets the point. But from here, how we actually calculate it, the probability of A given B is equal to probability of A times the probability of B given A over the probability of B. So probability of A times the probability of B given A over the probability of B. And so in this case, when we find probability of y given x, it's the probability that our probability of y times the probability of x given y over the probability of x. And the probability of x given y is, I think, a way of looking at this problem from the standpoint of, okay, what is our feature value? Oh, given a label, can you give me a feature vector that might correspond to this label? And so that's what my professor talked about, how kind of generative AI works. You're given some type of prompt, you're given some type of label, and then it'll spit out whatever your model thinks that label will look like, or some of the values that label would have. And in this case, the way we calculate it is, I even have it right here. I wasn't even paying attention. But x is equal to a feature vector, y is equal to a label. So we find the okay, so we find the conditional probability of this by finding the probability of x is equal to some label, and the probability of x is equal to some feature value times the probability of y given x is equal to some future value divided by the probability of y is equal to some label. But an important thing to understand here is that we have to do this for all of the feature vectors, all of the feature values within the feature vector. So probability of x is equal to, let's say, there's three different features. So height, weight, two different features, height and weight. Then we would have to do probability of x is equal to this height, let's say 100, 5 feet 7, weights 140. So a probability of x is equal to 140 pounds. Probability that the weight is equal to 140 pounds times the probability of y is equal to yes, given the weight is equal to 140 pounds, when we divide that by the probability y is equal to yes. But we don't really need to, I think, because all of these are going to be the same probabilities. And we do this again with probability of x is equal to height. So probability that the height is equal to 5'7", given probability of height is equal to 5'7", times probability of y is equal to yes, given probability of x height is equal to 5'7". And so what naive Bayes assumes is that the two feature values are independent of each other. So the fact that I weigh 140 pounds has no correlation or has no effect on whether or not I weigh 5'7". And so this allows us to take both of these probabilities, these two conditional probabilities, and multiply them together. So if that wasn't the case, then we would have needed to compute the probability of x given y. So the probability that I weigh 140 pounds given the probability of y is equal to yes, given the I'm not too sure here. Let me see. The value feature value x identically distributed though. Right, so this is what I meant by you're just multiplying these different probabilities together. Although, yeah, xn is the nth feature value, n is the number of feature values in a feature vector. Okay, yeah, this was definitely harder. Yeah, I'll do hard. Oh, back propagation. So this is a way to optimize our neural network. There's forward propagation and back propagation. So I think the main thing with back propagation is you need to find gradients for each of your hyperparameters. So the gradient is a vector of partial derivatives. Vector of partial derivatives. When you have a neural network with multiple layers, each layer has its own activation function. And then also within the, each layer has its own activation function, but also in between the layers you have this linear activation. Each of the activation functions have their own gradients with respect to the inputs of the activation function. And those inputs have gradients with respect to the weights and also partial derivatives, sorry. I'm saying gradients, but I think correct terms they're considered partial derivatives with respect to the weights and the bias. So I think first thing is finding the gradient or vector of partial derivatives. Second process is to get that to 0 as close as possible. What is this? Find partial derivative predictive value with respect to all the weights, sums, and activations. It depends on optimizing a loss function with stochastic gradient descent. Okay. Yeah, I'm remembering the quadratic loss. Okay. So the optimizing function with stochastic gradient descent. So this is, in order for backpropagation to work, we do need a loss function. I think that's the key thing I'm missing here to be able to optimize. And so gradient descent pretty much finds the smallest partial derivative or the smallest gradient, which is the gradient whose values are minimized as small as possible. Alright, I am going to probably head out now. Gotta sleep soon. I gotta wake up pretty early, so I'm gonna end this here. Honestly, an hour and 20 minutes wasn't too long, but yeah, good thing I did review some of this stuff because I'm starting to forget a lot of it. Yeah, I will see ya in the next one.